All right, so this lecture is mostly going to focus on bonds issued at a discount. We will kind of at least cover the issuance of a bond issued at a premium, but the rest of it is really going to focus on bonds issued at a discount. And so, anyways, kind of jump right to it. So they issued 610-year, 9% semi-annual bonds on January 1st, 2025. Each bond has a face amount of $1,000, and the bonds were issued at 98. The key difference here, of course, is that they're issued at 98, meaning they were issued at a discount. And so when we go through to do that journal entry, hopefully it's not too bad. Again, 600 $1,000 bonds issued at 98 means that in total, the price of the bonds as 98% of the total par value or $588,000. And what does that mean? That means when I issue them, I get only $588,000, even though the par value of the bonds is still $600,000. Again, I'm still going to pay $600,000 at maturity, but the market is only going to pay me $588,000 for that because the interest that I am paying is is less than what they demand. And so the difference between those two then is the discount on bonds payable. And so that discount is a contra liability. So notice it's still a liability account, but it has a debit balance. And so over time, we will amortize that discount. And as we do so, eventually we will reach the par value in terms of the carrying value of the bond. But again, the idea here is because they're undercompensating interest, the market will not pay them the full par value. In the second example, 500 bonds, 8% semi-annual bonds, they're issued at 102, which again, then that means it's a premium. And so them being issued at a premium, again, the idea here is that they're receiving more than the par value. So they're going to receive $510,000 for these bonds. And so the cash that I receive is more than the par value of the bonds. That difference then is the premium on bonds payable. That's a normal liability account. And so that $10,000 is the amount of the purchase price over the par value. Again, we're just kind of covering the issuance, and now really we're going to focus more on the discount bond. But anyways, but basically, the whole idea here is that we're going to apply the time value of money, which is the effective interest method to this. And so the whole idea is that we're going to make sure that our accounting reflects the economics of the situation to accurately reflect what the market demand for interest is on this debt, rather than focusing on the contract rate in terms of the income statement. And so we have this basically this interplay between what's going on in the market and what's going on in the contract. And so again, the issue here is we have something that's being issued at a discount, or whether it's a premium, we do need to apply the time value of money and create an amortization table. That amortization table then is going to show us what happens to interest payments, interest expense, the discount, amortization, all of that. It's going to show all of that and what happens over time. And so that table after the issuance, that table drives the rest of the accounting. And so you really know how to create, you need to know how to create an amortization table, and you need to know how to apply that amortization table to the journal entries after the initial issuance. Now, the nice thing is this is very similar to what we already did with debt investments. And so a lot of the calculations are going to be very familiar to you. All right, so again, step one, we have a situation like this is we do need to solve for the bond yield. And so we use our TVM inputs to do that. Again, marching through this, it's 20 semi-annual periods. I, as the bond issuer, will be paying $1,000 per bond at maturity. I do everything on a per bond basis, just like I did with the debt investments. Each interest payment is $45, again, for each bond. I receive $980 for each bond. And so this is the whole idea of this is the contract. So kind of these three, this is the contract. This is the market's pricing of that contract. And from that, we can infer a yield. And in this case, the yield, which we would expect, is slightly more than the semi-annual contract rate, which is 4.5%. And so that yield is 4.6558%. And again, we're going to use this information to create the amortization table. From the amortization table, we have all the information we need to do the subsequent journal entries. Without the amortization table, we would not be able to do the subsequent journal entries. And so when we look at our table, we take the information from our time value of money calculation. And we can see that basically initially we have an amortized cost of $980. And again, just to clarify what that means, it's the par value of $1,000 minus the discount balance. That gives us the amortized cost. And so then with the first interest payment on June 30th, we kind of walk through the different calculations. First of all, we do have the contractual interest payment. The interest expense is the yield times the prior amortized cost. So $980 times 4.6558% is 45,063, which means the amortization is 63 cents per bond. And of course, what we are doing when we amortize is we are reducing the discount balance. And so the updated balance in the discount is $19.37. And again, now the amortized cost is $1,000 minus that new discount balance. And so the amortized cost increases. And so over time, the amortized cost will continue to increase with every single interest payment until by the end, it will end up at the par value. And again, we just do that same math over and over again. I skipped a bunch of years in between, obviously, but we're going to end up at that par value. And by the way, I built this in Excel. I think it'd be good for you to learn how to do that as well. So see if you can build these out in Excel. It'd be really helpful. But anyways, what the whole idea is we take this information, now we can do our subsequent journal entries. And so the June 30th, 2025 journal entry is built off the amortization table. And the first part of it is the cash payment is again that $45 interest payment times the 600 bonds for a total of $27,000. Again, we as the issuer are the ones making that payment. We're going to amortize the discount. Again, the amortization is 63 cents per bond. We apply that to all 600 bonds. And the amortization of the discount, just to be clear, the discount balance, again, it is a contra liability, which means it has a debit balance. And so to amortize that, we would credit that account, $378. And then finally, the interest expense is the $45.63 per bond times 600 bonds for a total of $27,378. So that is our journal entries. Now, conceptually, we know we calculate the interest expense and the interest payment, and we derive the amortization. Just sort of conceptually from a journal entry standpoint, really the way to build it is it's changes in assets and liabilities, and they drive the interest expense. And so the method of amortization of the discount is what's driving the interest expense. If we amortized the discount differently, then we would have a different interest expense. So 12/31/2025, hopefully not too difficult. Same accounts, just different amounts. Cash payment is the same at 27,000. The amortization of the discount is 66 cents per bond for a total of $396. Therefore, we derive a different interest expense based on the updated amortization amount for a total of $27,396. Again, that is the amortization of the discount, which is driving the way we record our interest expense. And this is collectively known as the effective interest method. And so what would they report on their balance sheet, or sorry, on their December 31st balance sheet and income statement related to this bond? So first of all, we have to focus on where we are at in time. And so where we're in time is at December 31st, 2025. And this is the amortized cost of the bond at that point in time. And so what would we report? Well, first of all, the bond is going to be reported on the balance sheet under long-term liabilities. And it's going to be reported at the amortized cost, at that $981.28 per bond applied to the 600 bonds, means the balance in our bond payable on the balance sheet would be $588,768 or $588,768. The interest expense, again, it's the accumulation of activity over the year. And so there were two different journal entries related to interest expense. It would be reported under other income and loss, and it would be the sum of the June 30th and December 31st journal entries. And so for those two, again, we just calculated those. the total would be $54,774. So that would be reported on the income statement. Another type of discount bond is a zero coupon bond. And so basically, in that case, there is no contractual interest. And so in that case, there's going to be a pretty steep discount because obviously the stated rate is zero. And you compare that to the market rate, which could be 9, 10, whatever percent, that's going to be a very large discount. And so if we kind of go back to the prior journal entry, again, we highlighted that the interest expense was driven by the interest payment and the amortization of the discount. If there was no interest payment, then the interest expense would be driven only by the amortization of the discount. And so with a zero coupon bond, that is the situation we're in. And so the interest expense is only going to be the result of the amortization of the discount since there is no contractual interest payment. Now there's going to be a very substantial discount. And so the amortization for that discount is going to be pretty large in any given period. And so how do we handle this? So 49er Company issues 500 10-year zero coupon bonds on January 1st, 2025. Each bond has a face amount of $1,000. They mature December 31st, 2034. And again, what does it say here? It says, let's record the issuance and the adjusting entry for December 31st, 2025. So why will the bond require an adjusting entry? So in the prior example, the interest payment happened on December 31st. And so if we're preparing financial statements on that same date, really there's no reason to accrue any more interest. There's no time that has passed, so there's no adjustment that needs to be made. But in this case, there's been no payment. And so by December 31st, when we're getting ready to prepare our financial statements, we need to do an adjusting entry. And so it's very typical with a bond where we apply time value of money on an annual basis. And so that December 31st journal entry is going to capture the annualized amortization of the discount. Now, technically speaking, could we amortize and adjust more frequently? Yes, we could. But normally you do the amortization process on an annual basis. If you choose to record it more frequently, you would just partition it out. So if you did it every quarter, you do 1/4, 1/4, 1/4, 1/4. If you did it every month, 1/12, 1/12, 1/12, and so on. But again, for this, we're just going to do it annually to keep it fairly simple. All right, so how do we do the TVM? Well, first of all, again, hopefully you're used to this. It's 10. Again, we're going to use annual periods or annual amortization. The amount we're going to pay at maturity is $1,000. There is no payment, and we were told that the price is $305 per bond, which means the yield on these bonds is 12.6082%. So we use that information to create the amortization table. Initially, the discount balance, again, is pretty large per bond, $695. There is no interest payment. And again, over time, what are we going to do? We're going to amortize the discount. And the way that we do that, again, is we calculate the interest expense, which in this case is 12.6082% times the amortized cost. That gets us the interest expense. And again, the amortization then, since there's no payment, is the interest expense. And so over time, that discount balance is going to go down to zero, which means over time, the amortized cost is going to approach the par value. So when we record this issuance, hopefully not too difficult, but the cash that we receive is $152,500. The par value of the bond is still $500,000, 500 times 1,000. And so the difference then is that contra liability account or that discount on bonds payable, the discount on bonds payable. And again, over time, that discount is going to go to zero, which means then the amortized cost is going to approach the par value. So the first adjusting entry on December 31st, 2025, we just take the information from the table. So the amortization is $38.46 per bond. We apply that to 500 bonds for a total amortization of $19,230. And from that, then we can get the interest expense also of $19,230. All right, so we're going to stop there. And the next one, we'll start to cover our bonds issued at a premium.